See, a lot of the people that I know are in the single family space and have not invested in a syndication and probably not a fund either. So excited to share with you what I've been working on. So I won't bury the lead anymore. I'm launching a fund, and it's a hard money lending fund, and that is the topic today. So let me go ahead and share my screen. The name of my fund is called One Call Capital, and I'm offering the investment thesis is that I'm offering consistent returns in a volatile market, and we're going to be talking about that. So please, this is a fairly small group, so I should be able to be fairly interactive. Please feel free to drop questions in the chat. Any questions you have, I want to help address them. And let's just dig into this thing. If you see me looking to the side, I'm looking at the screen that I can see versus the screen that has all your questions on it. So agenda, we're going to go through this quickly, 20-30 minutes of me talking. I will answer questions as you bring them up, and I will really just kind of explain what a fund is and explain how they work and what I'm doing in my funds, and then we'll have an open Q&A at the end. And if you have any kind of time constraints and you can't make it for the entire presentation, is no problem. Feel free to go ahead and scan that barcode that takes you to a link that is my calendar. And if you are interested, you want to learn more, go ahead and capture that link now. I'll provide the same QR code at the end so that you can book time on my calendar and we can talk about this one-on-one. All right, everybody grab that QR code, get your phone, QR code. Last few seconds. So the disclaimer here is that I'm not a tax advisor. I'm not an attorney. I'm not an investment advisor. Obviously, I'm not portraying myself as one of those. You're going to need to make investments based on your own risk profile and on your own goals, and you need to seek counsel to. I'm not giving you that counsel. I'm not giving you any kind of personalized advice because I'm not qualified. What is this for? Like, who am I targeting this fund for? So basically, I'm offering an investment opportunity inside of a fund that is for passive investors that are looking for a consistent place to get a consistent return in this volatile market with a lot of these things we'll be talking about here in the next few minutes. And this is a little alphabet soup here for a second. This is what they call a Reg D 506C fund, meaning it is only for accredited investors. And if you don't know what accredited investors are, the definitions is there in front of you on the slide. I'm not going to read them to you. You can kind of do your own little research to see if you are accredited or not. If for some reason or for any reason, there's no problem if you're not. If you're not an accredited investor, there is still an opportunity for us to work together. It just won't be in this particular fund. So still go ahead and set up a call with me. We can talk about your investment options, and I can just give you referrals at the very least. But there is another option that I'm not going to go into too far tonight, that if you haven't hit that threshold of accredited investor, it can take a little while to get there, no problem. But this is specifically a fund for accredited investors. And the reason that is the case is because accredited investors are basically, the SEC doesn't feel like they need to be as protected from people who are soliciting investments in the same way if you're not accredited. That's the spirit behind the purpose of having an accredited investor. And when I use accredited investor fund, then I'm allowed to talk about it openly, and I can basically openly advertise, which gives me a lot more flexibility in raising capital. Okay, so let's talk about what is a fund. So there's basically 4 steps to how money flows through a fund. And a fund is set up with a GP, general partner, and a LP with typically many limited partners. And that's the LP. The GP is me and my team, and we're the ones that direct the fund's management. The LPs are the ones that contribute capital. So let's say when you decide to invest in One Call Capital, you contribute your funds to the limited partners. You basically get shares of this limited partners LLC, and then you are now investors inside of that. And then as the GP team, we make investments according to our guidance and according to our investment criteria, our investment thesis. And then we go and make our investments. And I'll talk about what those are here in a minute. And then when the funds come back, the investments go do their thing, we get returns from our investments. And based on our decided agreement, then the profits are split between the LP and the GP. And what I'm offering is a 12% preferred return. I'll talk about what a preferred return is here in a second. But basically, the idea behind it is that the limited investors or the passive investors get paid back first before the GP team gets paid. So 12% has to come in before the GP team gets any of the split. Okay, I know that's a lot of information in a little bitty space there. What questions do you have about that? Have you heard of this structure? When you hear about a hedge fund, you hear about a debt fund or a real estate fund, they're pretty much all set up with very similar structures. They can get very complicated, but fundamentally there is a GP company and there's an LP company, and the GP company makes the investment decisions based on a predefined criteria, a predefined set of rules that are our strategy that we've all agreed to, and we've shared with the limited partners. Limited partners raise their hand and say, you know what, that sounds like something I'm interested in. I want a 12% return. Good question, Tina. On this particular investment strategy, there are not cost benefits, there are not cost segregation, because this is a debt fund. Basically, I'm offering loans to other people. There is no bonus depreciation. There's no gas well tax advantages or anything. This is just a very simple, by design, very simple fund. Does the fund have stated criteria what it can and cannot invest in? Yes, that's set forth in the PPM, Courtney. So, but basically it's real estate assets with the primary goal of being on for debts. So basically, if it's real estate and it can have a debt against it, that's what this fund is focusing on. But the PPM details that in great detail. So the flow is very simple. Investors into the LP, the GP directs the LPs, the LP LLC to make investments. So in this case, it'll be loans. So loans would be 2 properties. And so the prominent mortgage will be the mortgagee of that would be the limited partners LLC. And then when the funds return back after the loan is paid back, and then the profits are split according to the PPM, which is in this case 12% preferred return goes to the LPs, and then the waterfall goes to the GP from there. So a good thing to know about a preferred return is that preferred return is not a guaranteed return. It is that the LP investors get paid back first, and then the GP gets the profit afterwards. Are investments spread across many clients or investors or matched with specific clients? Good question, Todd. No, this is a pool of funds, and the whole reason I'm doing a fund is because it allows me to pool money. And so Todd isn't matched with one loan, and then let's see, Alex is not matched with another loan, and then Courtney is not matched with another loan. All 3 of you in those cases, Todd, Tina, Courtney, John, Todd put money into the LP fund, and then that pool of money is then directed out into the marketplace. And so that's what the GP team does, is we spend our time evaluating deals, doing our due diligence, doing the back office of what it takes to make sure the documents are set up correctly, and managing the back and forth it takes to get a loan set up, et cetera. Minimum investment for this is $100K, and there's a 1-year commitment, David. And there's a question right here. It's from David. So what is the minimum investment time? That's 1 year. And at the end of the year, you can continue to roll your money, or you can have your money back, have your principal back. Good question. All right. So speaking of the company, the GP, Paul, me, I think most of you know me on a first name basis, and if not, we'll talk about that in a second. Is the GP, and then I have 2 kind of decision makers that help me review all the loan applications. So that's Kyle, who is my chief operating officer, and Brad DeGraw, who is the loan officer for the GP team. And we have you can read there, we have a variety of experience, and Valerie is our kind of bookkeeper, controller, accounting person so that we can file taxes. She runs all the books for us. So important distinction here is this is not just Paul running a fund by himself. Paul has a team, and my primary function in the company is to raise capital and to do the final approvals of loan requests. So we have to have at least two of us have to approve the loan. So it's usually Paul and somebody else has to approve a loan, and Brad and Kyle kind of act as the loan committee, and then Paul approves it, and then Paul sends wires. It's very important for there not to be single man failure. So if something were to happen to me, then the company still runs. There's not any sort of removing myself as a single point of failure. The only thing that the company couldn't do if I weren't there is to raise more capital. But the capital that's been deployed, the capital that's out to work, can be run by the team. It's very important. Payouts, how often? Quarterly, Todd? So quick background. Some of you probably know a lot of this because I know most of you pretty well, but I used real estate as a way to get out of my day job back in 2015. And I started with single family. And as I was doing that, I was learning about how to lend out of my IRA, my solo 401k, and some taxable accounts. And I really liked that side of the business. And as my capital position grew, I did more and more loans. But I've gotten to the point now where the demand for potential loans has exceeded my own personal capital. And so about 2 years ago, I started a very small company with several investors similar to you guys, where we pooled money together into an LLC, and they were all voting members of the LLC. And then we ran a little small lending company, and we called it Freedom Fund. And that company's been around for 2 years, and we've issued several loans out of that. And that was my proof of concept on this idea, because I knew I wanted to do a fund one day, but I wanted to do it with training wheels. And now that I've done that and I've returned the capital, we're about to kind of rewind down that business and take all that capital. People who want to roll that into this fund can, or people who want to keep their capital, fine. And so this is now time for me to transition into having a full-scale fund that's registered with the SEC and uses this GP-LP structure, which is how you do things at scale. All right, so let's talk about the problem that this fund is designed to solve. So there are two cases here. The first is capital investors, like those of you who are on here, who have capital who want to deploy. In the market cycle right now, it's kind of weird place. It's inflation is high, so if you're just sitting in cash or you're in savings accounts, you're losing money to inflation. The interest rates are up and down. The public markets are extremely volatile. We certainly know what's happened with crypto. Like, where does an investor go to find yield, to have minimal risk with maximum gain? And that's my investment thesis is around solving that problem. But then it also solves the problem to the clients of our hard money lending fund. Is there are still investors, operators out there who are finding deals like the one pictured here, that there's opportunity in the marketplace, but the markets the lending market has constricted a little bit. It's a little bit harder to get a loan, and it's a little bit harder to make these deals happen. But there are opportunities in the marketplace that are bubbling up, and a lot of these investors are having trouble getting the capital deployed in time. And we all know, as a real estate investor, oftentimes being able to close quickly makes an investor able to snap up some really good deals. And when they have trouble raising the capital, time kills all deals, and the deal falls apart, and the seller does something different. So those are the two fundamental problems that I'm trying to solve. So the solution to this is this fund that has this concept of offering investors the ability to invest in debt without having to spend all their time and energy evaluating each deal every time. So basically, I'm connecting capital that is looking for yield with investors who know how to find deals, but need to have access to that capital quickly. Then okay, now I pool money together into a fund, and now we're able to be nimble and underwrite deals quickly because it's fundamentally deals that we're comfortable with, and they're investors that we typically have worked with a lot. And we can offer these loans to investors for a high yield for both the capital investors and for the GP team. And we can charge a little bit higher interest rates because the market kind of has adjusted to where we can afford to offer our above and 12% rates. And then we use that property as collateral. So it's a traditional lending situation where a bank uses the collateral, uses the property as collateral. We're doing the same thing. The fundamental investment thesis here is that debt is now an interesting thing to invest in, whereas 10 years ago, when interest rates were at, sub 3%, debt was not as valuable of a thing to invest in. So I want to create a scenario where you could take the least amount of risk while getting the most reliable, consistent return while using physical hard assets as collateral. And that's what this hard money lending fund is all about. Concept is very simple, but we have to get all the different pieces together so that we're able to be nimble and we're able to go out and pre-raise capital and then deploy it for the right deals. Okay, so let's talk about the types of loans, the strategy that we're specifically doing. So most people think of, when you hear a hard money lender, they think of fix and flippers. And we will certainly do some degree of that, but that is not necessarily where we want to spend most of our time. So I'll have a pool of capital to deploy as a part of the One Call Capital, and I can get that money to work with these three types of loans. So the classic situation is lending to a fix and flipper, and you can see the interest rate and points that we charge based on what's going on in the marketplace. And then land flippers are where we spend quite a bit of time over the last year. That's where I've spent a lot of my time is helping land flippers flip land. And this is a place that a lot of wholesalers are going to now. And there's a really big market, and we have so much demand for raw land that is being purchased at 20, 30, 40 cents on the dollar. And then we land no more than 50% on the dollar. And the land flipper then turns around and sells it. Raw land is an incredibly interesting business. And then bridge financing is, I've also gotten into the construction business, or I've gotten into the land development business. And a problem that I've seen that we can solve is when a deal is just about to be finished and their 2-year interest-only loan is due, and they just have 6 weeks, maybe 2 months worth of work left to get the property perfectly developed to sell to a builder. And so in that case, what we do is we step in and we bridge, and we basically extend their loan for 6 weeks, 12 weeks, 6 months or less. That just gives a developer time to finish the last few hurdles it takes to get the construction project ready so it can be sold off to a big builder. And in that case, we only take the loan is if they have a signed purchase and sale agreement with the end builder, which is a very common scenario for a developer to go and develop land, get it entitled, and they do the horizontal construction, pull the sewer, pave the roads, put the curbs in. And while they're waiting to get the curbs in, their time is ticking, and they have a contract with the end buyer, which is the builder, like big sums of money, and they just need a little extra time and a little extra capital in order to extend to buy themselves the time to finish up their last bit of construction. That's bridge financing for construction loans. Okay, let's roll through the process of what this is. Of all your flips, how many would you say you lost money on? I would like an idea of a track record of underwriting. For deals that I've personally done, I have lost money on a few flips. On deals that I've done loans on, the lender hasn't lost money. Sometimes the flipper has lost money. So it's not uncommon for that to be the case, for the flipper to have to come out of pocket to cover the last bit of loan because they didn't make as much on that flip as possible. So I'll roll through this investment process real quickly. Step one is basically we underwrite the deals, kind of in line with the question that Todd just asked, is as a GP team, we underwrite the deals and to make sure that it meets our investment criteria, that it hits a certain loan to value ratio. And then we really like to partner with established operators, so we're not having to kind of revet a new borrower every time. We typically like to find a few really good borrowers and just rinse and repeat with them because they've proven themselves, along the lines of what Todd just asked. And so our process is that we go through this underwriting process of going through our standard operating procedure, of doing our checklist, make sure things, all these things like, is it in a flood zone? There's a whole thing that's specifically made for a checklist kind of situation. And then we confirm that there's an insurance in place on the property if there's an improvement on it. And then we also do, of course, a title search, and we work with the closing agent to make sure any kind of insurance that's required is in place. And once everything kind of passes our underwriting and I approve the loan, then we fund the deal and we use the property as collateral, and we use a security instrument, either a mortgage or deed of trust, depending on what state we're in, and then a promissory note. And then depending on what's happened, we might also do a UCC1 filing. So we just basically fund these deals, and the money goes from the with the GP LP scenario, the LP is where the money sits, and the money goes from the LP LLC to the title company. The money is never going through to the borrower, and it's never going through to the GP company. It's going from the LP to the title company. They run their deal. When the deal is being paid back at the end, the funds are returned from the title company back to the LP. And then from the LP, the profits are split based on the LP GP split. And along the way, we collect interest payments as step 3, and we do a payout of investors. So collecting interest payments is actually a pretty easy process. And then we will hold quarterly calls with the borrowers just to make sure we're up to date and we're current, and making sure that the project is going to plan. If it's specifically if it's some sort of a flip, or if it's some sort of a construction situation, we want to know what's happening on the ground, so that it kind of, like we feel like the borrower is doing what they've promised that they would do. And then as these funds are returned, these are short-term loans. We get the loans are in and out much less than a year's time. So that allows us to be able to pay back the capital partners on a quarterly basis. Has anyone on the GP team had to take back a property or foreclose on a loan that they gave? If not, what is the SOP for default? Yeah, good question, John. So we have not had to, this new entity that's being created has not done any loans yet, so it hasn't had any defaults. In my personal business that I've been doing this for the last few years, I have had 2 situations where there's been a default on a borrower. One is where the borrower actually died, sadly, and when we had to foreclose, there was no other option in place. In another case, the borrower just did not have their wits about them, and actually it was kind of a mental health issue situation. And we were able to solve that with a deed in lieu and did not have to do a foreclosure. So if you do enough loans, you're going to have something that doesn't go to plan. And that's exactly why we have these kind of careful loan to value ratios, to make sure that when we foreclose on a property, that the lending company is made whole by either selling the property, or we could just fix and flip the property, for example, if we wanted to. Typically, that's not the case, though. We really just want to sell the property, get our principal back, so that we can pay back investors and go on with the business of lending money. Okay. So then on step 4, you focus on working with repeat borrowers that have a proven track record. That is the kind of the principle of success in any sort of small lending company, is we don't need hundreds of borrowers. We need hundreds of transactions with a few borrowers. And then we're always reviewing those internal operations to see if we can make things a little more smooth. Any way we can take a risk off the table is definitely. I mean, like anytime you're a lender, you're always thinking about risk, and you want to basically remove as much risk as possible while still maintaining a decent return. And so then you repeat steps 1 through 3. So really, it's kind of interesting. The business that I've run for the last 2 years, one of the lessons I learned from the borrowers that came into it, and not the borrowers, the capital investors that joined it, is they expected it to be a much more interesting, up and down business. Lending is actually a very boring business. You do loans, somebody else goes and does most of the work, you collect interest payments. And 99% of the time, 90% of the time, the vast majority of the time, there's no problems. There's not a lot to take care of. And then you only spend your time on the few problems that pop up. Interesting thing to note that I will have to set expectations. I've noticed as a GP to LP, there's going to be a lot of communication there for one, and two, that modify your expectations that when you put money into even a syndication or a fund like this, there isn't a lot that happens. There's like, hey, we did another loan and we got more interest that came back. Whoop-de-doo. There isn't a lot of fanfare. There's not a lot of ups and downs in the business, which I like personally. But if you didn't know that going into it as a capital investor, that might be a surprise. Good question, Colin. In this case, so I'm going to combine the question from Colin and Todd. Todd says, how does the GP get paid? And Colin asks, is there a way for participate in the profits? So with this structure, I've potentially or intentionally assigned a very high level for the pref, meaning it's 12%. Oftentimes prefs are 8, 9, maybe 10%. 11 or 12% is not very common. So basically the GP doesn't get paid until 12% is made, and then what happens after that. But as you see, the upside of this isn't there's not a lot of upside to this business. The upside of this business is the turning of the money. So as the money turns, that's how the GP makes money. So yeah, so he says agreed. So the upside, there isn't much to play with there. So I'm not offering an upside potential. I'm offering consistent, boring returns. That's my pitch. I'm the boring fund. And there are other funds out there that have the potential for much higher returns, but they're typically doing much higher risk investments where all your money is on one, like you do a syndication, all your money is on one big project. And if something doesn't go right with that one big project, your option to continue to make a high return is much lower. Whereas this fund and the GP strategy is spread out over a variety of small investments. So if something doesn't go right, it's not going to affect the LP's pool of funds as much. Todd said that he's seen some prefs as high as 10%. I'm guessing those are on multifamily projects for syndications. Hey, Makisha, what is the required minimum experience of the borrower? So it depends on the type of loan they're doing. If they're doing a flip, and the loan is over $100,000, I want them to have done a few I don't want to be, as a lender, I don't want to be their first loan. As a land flipper, I'm much more open to that because it's so much easier to step in and fix that. And the loan sizes are so small. So the loan sizes are usually less than 50 grand. So I'm taking a whole lot less risk on a land flip than I am on a house flip, which you'll see here in a second. I have some examples. Good question. And in case since you were late, Makisha, the minimum investment is 100,000. Good question, guys. This is good. Okay, let's move on. Okay, this is the terms. So you guys kind of beat me to the punch here a little bit, but the GP is called the One Call Capital. The LP name is called One Call Funding, and so the lender is One Call Funding, and the partnership size is $10 million. So it's a closed-ended fund, and once 10 million is raised, then we will stop. And if we want to do an addendum or we want to do round 2, then we can. But the goal is to raise $10 million with a minimum commitment of 100K. And this is a Reg D 506C for accredited investors only. If you are not an accredited investor but still are interested, I do have some other options for you. Just won't be in this fund. Minimum commitment period is 1 year. Target return is 12%, and intentionally the preferential return matches that of 12%. And as an important distinction, I'm not charging a management fee, which is not real common for funds. Typically, funds need to charge a management fee to pay their employees. We basically pay our employees through the points. Not all businesses have the option of charging points with their transactions, so that allows us to not have the management fee. So one call funding partners earn 12% return. That's the target return and the pref return. And then one call capital charges no management fee to the LPs. Some case studies. Okay, let's talk about the case study here. So this is a classic flip situation where we purchased the property for 80K. And in this case, this was one of my proofs of concept for myself. So the borrower on the situation was actually me and another contractor friend of mine, and the lender was this company that we put together. So I was involved in both the lending side and the flipping side, but this was me proving the proof of concept to me that I wanted to see how things work from every angle before I went and set up a fund. So this was very intentional in what I was doing here. So I'm going to say we a lot because I was involved in pretty much every side of this situation. So we found a deal. We put under contract for 80K. The rehab was 91K, and the loan to the flip company from the lending company was for 140K. And I followed all the same rules I would apply to this business, by the way. And we did it with 3 construction draws. So basically there's a closing that happens, and at closing, the borrower cannot walk away from the closing table with money. We don't want the money to get ahead of the construction. So then they go and do some construction. In this case, my team went and did some construction, and we did construction draws to the lender. And the lender goes and does a inspection and says, okay, you've done this, you've added this much value. We'll give you 90% of that value. You do a construction draw. And I modeled that after some from Fund That Flip specifically. I used them on a couple of deals of mine, and that I basically followed their rules for a deal of my own. And in this case, the interest rate to the borrower, I was the borrower, it was 12.25%. And it was a 6-month hold time. And we sold the property for 277K, made a good lick on the flip, but then paid out the capital partners at 12%. Accredited and not sophisticators only. So Lucas, good question. This is for accredited but not sophisticated. Like you have to meet the accredited investors criteria to invest in a one call capital fund. I do have other options. In fact, Lucas and I have done that other option before. It's basically a direct loan to my company, but was not a fund. I wasn't pooling funds. So David, good question. How do you check if an investor is accredited? I don't check. I send you through a portal that checks for you. Like you have to say you're accredited, and you have to like go get certified that you're accredited. And there's a couple different ways to do that, but I'll provide you a link. Any interested investors will provide you a link to go be able to basically check the box that they are accredited. Okay, let's go to the next example. So this is a case study where we did a land loan, and this is a land flipper. In this case, it was an infill lot. So this was in Georgia, and you see that little highlighted infill there, 14.7 was a vacant lot. If you notice from this deal, there's no improvements on it. It was vacant on McKay Circle. And so we did a loan for only $18,500. So this is very common with these types of raw land loans. The risk level is so incredibly low because the loan to value on these things is usually 50% or less. Well, in fact, we require it to be 50% or less. A lot of times they're buying it at 20, 30 cents on the dollar. And the terms are no longer than 6 months. And then somewhere along the way, they paid us back. In this case, it was 21.5, and there was a payout of 12% to capital partners. At this point, I think we have done, we closed on one yesterday. So we've done 21 of those in the last year. So we've gotten very comfortable with the land flip business. It's of the 3 different kind of stools in the leg of loans that I do, this is the one I like the most because they're just so easy. And so what you see on the left here is actually our loan commitment letter. And these are the things that we require before we will issue the funds to the title company. So I spend most of my time reviewing these types of properties, making sure that they meet all of our criteria, and then we send these loan commitment letters to the lenders and to the title companies. And so we spend a lot of our time talking to title companies because we're just going through a lot of closings. I'm guessing a lot of you aren't real familiar with land. This is, I think, the big opportunity right now in the marketplace. If you're an active investor, land flipping. I know a lot of wholesalers who have switched their business from marketing for single family to marketing for raw land. And it could be infills like this one, or it could be out in the rural as well. Usually it's, recreational land is what we do. A lot of recreational land flips. We do loans on land flips. So this is a case study. Again, in full disclosure, I am a principal in this transaction, but it is a incredibly interesting one. So it's a land situation where it's a loan for 160 grand. This is 23 acres outside of Dallas, Texas, that we're developing into townhomes. And again, I'm a principal in this, but we have a lending company. So the lending company stepped in second position on the situation and lent. Actually, no, this is first position. Purchase price was $700K, and we have a 23% loan to value. So very low risk. Term, in this case, was 12 months. The maximum will go. And the payout was basically we refied the situation. We refied out with a bigger construction loan from a commercial entity. And in this case, the payout was $184,000. And again, paying 12% back out to the capital partners. If no questions come to mind, I will move on. Okay. And so basically the conclusion of this is, if this has piqued your interest, if you are accredited, definitely scan this, book a call with me. And then if you're not accredited, but you're still interested and you have some capital to deploy, you can still book time where we can talk about your options. Just your options right now will not be in this particular fund. I can do other one-off type loans for specific deals. So GP paid with upfront points. So the GP is always paid from the LP's company. So the LP receives all points, all incomes, and then we look at the returns and we pay the returns out to the LPs, and whatever is left over is paid to the GP. And then the GP pays its expenses. And there are expenses that are being incurred on the GP side. So not everything that you're seeing from the LP to the GP is always profit. It's just income to the GP to cover our expenses like filing taxes and employees and commissions, et cetera. Closing costs, wire fees, it does that up. What real estate markets are you investing in? Good question. So for fix and flips, I'm very careful. I really like to know a fair amount about the markets before I do a fix and flip loan. For the land, we do that all over the country. We are very experienced and very comfortable doing land loans from Georgia to California even. There are a couple of states that we avoid, and that's New York and most of the New England states. New York just takes so long to foreclose that we don't want to just deal with that. And the New England states just tend to be harder to do business in. And there's just not enough land up there to fuss with. So North Carolina, Florida, Texas are definitely the three biggest. We've done quite a bit in Georgia. Georgia's probably number 4. Texas is our favorite. Like I always lean towards Texas. If I can do everything in Texas, I would. But I get a lot of loan opportunities in North Carolina, Florida, Georgia. LPs are paid quarterly. It's an annual. So if you put in 100K and you get the full 12%, then you're gonna get $12,000 over the year. Yes, I do have skin in the game. So I can invest, according to our PPM, I can invest up to 500K into the LP. Great question, Todd. I wish I had asked this before. Can one invest their solo 401K funds? Yes. So self-directed IRAs, self-directed HSAs, solo 401Ks are absolutely eligible. The only thing we need to watch out for is that anybody's solo 401K or self-directed account cannot be more than 50% of the LP stake. because then that would create a problem for you with the IRS. So probably not a concern, but if somebody, say we're doing a $10 million raise and somebody showed up with $6 million out of their solo 401k, that would not be a good idea for them. They would be breaching, they'd be creating a disqualified transaction for themselves by doing that. Probably not a concern, but just something we want to be aware of. And I can't invest my solo 401k in this because I'm a principal in the GP. That would be that'd be a disqualified person and creating a prohibited transaction. If you're investing with a solo 401k, you as a person still have to qualify as a accredited investor. You can't get around the accredited investor by using your retirement accounts. You still have to be an accredited investor. If anything that doesn't go to plan, or there's any kind of hassle, the GP company is intended by design to be the one handling all the operations of the business. They are the fund manager. Exactly. Does the PPM limit LPs and GPs from receiving loans from the fund? Good question. I don't know. I'm going to check that, John. I don't know. Yeah, in the event of my untimely demise, then everything is intentionally planned around the fact that something happens to me, that the company still runs. They have directions to basically finish out the loans and close up shop. But the operations of the GP still goes on as normal. They have provisions to take care of that by design so that there's not a single man risk. That's very important. If Joe, okay, so Tanya has a question. If Joe invests 250K and Sally invests 100K, they would each receive 12% based on each ROI. Yeah. Whatever your basis in the company is, you get 12% on. Exactly. So it's just like if you invest in a stock, if you have shares in a company, it's the same way. You're buying shares of this LP company. You'll be Class A shareholders of an LP by investing in this. This is a fascinating world of fund management. I've always known that I've wanted to dip my toe into it, but it can be fairly complicated. I wish I'd done it earlier. Like it's definitely what I'm going to be doing. Like this will not be the first fund. I will probably have funds after this, or I will amend this fund to do more. But like with everything in life, you have to like just take your steps. Like you have to learn how to go walk and crawl before you can sprint. How do you envision this going after the 1 year's up? So Todd, good question. So this fund will exist for many years to come. I intend to be doing this for 20, 30 years. So this fund will exist as a hard money lender for years to come. And after a year, each individual LP chooses to either recast their investment or ask for the principal back. Which is, by the way funds work. It's super common. Like it's not unusual for there to be a minimum commit time for it. How will you handle idle cash in the LP account? Good question. There will almost always be some idle cash, John. And that's one of the situations that came up with the previous company that I had, that it's still winding down, that there's idle cash there. So that's part of the reason why we have 3 different types of loan products, so that we can minimize the chance of having idle stranded capital. We get pretty consistent loans that come in from loan requests that come in for very small amounts that we can deploy very small sums of money back into these land loans. That's why I like them so much, because they tend to be so small. So if I were only doing fix and flip loans and the loan amounts were 47, 100,000, 200,000, and I only had 50,000 in the loan or in the LP account, I couldn't do much, but I can with these land flip loans. Well, it's because that's me and my team. That's what we know. That's why. The question Bill asked is why these 3 loan products? Because it's what provides us the likelihood of the highest return while still having collateral, and it's fundamentally loans and fundamental real estate products that we understand. Like I'm not going into a warehouse space because I'm not into warehouse, but I have done single family, I have done land flipping, and I am doing development. So it's all things that I've done before, or me or my team have done before. And they get the highest returns. Like the development and the land loans give us the highest returns. So Todd has a question that I have. Do LPs take out quarterly, or can they just leave the interest in the fund? And I have that active question into the my attorney, because I have the first round of docs in and I've reviewed them and everything looks pretty much in order what we talked about. But that's the one thing that isn't spelled out explicitly enough for me. I would like to give the LPs and the option of, do they take withdrawals, or do they have the option to reinvest? Just like when you invest in a index fund, you have the option to reinvest or not. And I'm pretty sure the portals that we use give us that option, but that's something I need to confirm. Because if I'm the LP in an investor, I want, I mean, especially if it's from a 401k or something, I just want that thing to roll. I don't need the cash back, because then now I got to do something with the cash. So that way I can compound the investments. But that's a open question, Todd, for me as well, to make sure it's stated in the PPM what that option is. And then assuming I can make it happen what I just said, then it becomes the election of the individual LP investor to make the decision if they want their distributions or not, or if they just want to keep it rolling, reinvest. Another thing is, we will be filing taxes for the companies as a GP fund, or as the GPs. We have to make sure the tax returns are filed, and LPs will get a K1 each year for their investment in this company. Bill says, would I be open to fill the 50K investments? The problem with that, Bill, is with the 10 million. So the way this is written is I can take on no more than 99 investors with the way we set this up. And if I allowed too many people to do 50K investments and that's all they do, I would not be able to hit my $10 million mark. So, I mean, I guess if it comes down to it, maybe, but that'll be the last straw for this, because I very much intend to hit the $10 million mark and get a few years of loans under our belt, and then do an addendum and raise more capital. Because as funds go, this is actually quite a small fund, and we have the potential to go quite a bit higher. I've been under the tutelage of another hard money lender who has a fund for 25 million, and he says it's very doable, but get your 10 deployed and proven, and then you'll be able to raise money much faster. Lots of great questions. It's been almost an hour. I will answer anything else. I appreciate y'all's attention tonight. I look forward to talking to you each that are interested one-on-one. Until then, have a good night. Have a good weekend, everybody.